everyone. I'm David Darst, here to give you a recap of the month of September, which traditionally, as you may recall, has been one of the least performing in terms of equity markets in the 12-month cycle of a year progression. Now, the big story last month has been the labor market deceleration. August came in at only 22,000 jobs. The 4-month average turned out to be 27,000 jobs, and that compares to the previous year's monthly average of 167,000 job growth per month. So a big deceleration. Obviously, that affected the Federal Reserve's thinking, and during the month, they reduced interest rates by 25 basis points to the new level, policy level, of 4% to 4.25%. During the month, we also had developments on manufacturing and services within the U.S. economy. Manufacturing continues to be slightly in a contraction mode. Services somewhat in an expansion mode. The consumer retail sales were pretty strong in the month. The consumer continues to spend. A lot of the spending is concentrated by the top half of the wealth spectrum. But they have continued to spend, and looking at the second half of the wealth spectrum, as long as people have jobs, they've been willing to spend. The business outlays have continued with this new big tax bill and the deregulation themes that are in the current administration. So businesses have continued to spend, and of course you have this whole artificial intelligence capital expenditures outlays that are just so enormous. So you've got three stimuli. You've got interest rates down. You have federal spending and deregulation. And finally, you have this artificial intelligence boom. Right now, the odds of a interest rate cut at the October 28th, 29th meeting are 89%, according to the Fed Fund futures markets, and another 25 basis point cut expected December 9th, December 10th meeting. The odds of a second are 68% as of now. During the month, the S&P 500 was up 2.8%. Usually it's a negative month, so it was up 2.8%. And this is after 5 months in a row of continuous gains by the S&P 500. NASDAQ was up 4.8% for the month. NASDAQ is up 16% for the year. That includes all these technology companies. And the Russell 2000, which have come alive recently. Since August 1st, they have expanded about 11%, which is almost double what the stock market, the S&P 500, has expanded. Russell 2000 was up 2.9%, and it's up 9.2% for the year. The two-year Treasury, for the month, it was up 10 basis points to 3.69%, where that is 56 basis points below the beginning of this year. And that's basically because of the tendency of the Fed giving signals that they were going to cut interest rates. So you've seen short rates go down. Long rates are not down as much. The 10-year was down 3 basis points during the month so far. And the year-to-date, it's down 38 basis points to 4.20%. Oil was up 2.7% for the month. Maybe a little bit better a picture on the supply-demand balance there to 65.72 for West Texas Intermediate, where it's down 8% for the year. Gold up 8.7%. And there you have this dollar weakness story, as well as central bank buying of gold. You have 37.75 in that neighborhood, and it was up, as I mentioned, 8.7%. It's up 43.6%. Silver's up even more in the 50% range, and the gold mining shares are up over double thus far this year. You have had this great narrative of, after first quarter being down 0.6%, the second quarter, the final numbers come in at 3.8%, and preliminary right now, it's early in the month of October, but the third quarter is running at a rate of 3.9%. Inflation has basically been moderate. It's not been worrying, but it's not fallen, but it's basically stayed pretty stable, 2.7%. The personal consumption expenditures for August versus 2.6% in July, and the core 2.9% for both months. Basically, we've been counseling people. This is a great time to look at private real estate. You've got valuations in many sectors have become very attractive. It's an inflation hedge. It's a low correlation asset, and it's an income generating asset. So we think you want to give good consideration to private real estate in the portfolios. It's a long duration commitment, and we think it can be an enhancer as well as a portfolio volatility dampener. We've said this before. If you don't know diamonds, know your jeweler. And if you don't know real estate, know your real estate sponsor. With that, we wish everyone a great month ahead and look forward to catching up with you very soon.